let's dive a little bit deeper into all the factors that move markets today. And for that, we've assembled a Taking Stock think tank. We have Michael Woolfolk. He is a managing director of Bank of New York Mellon, where he focuses on currencies and global economies. We also have Stephen Blitz. He's a director and senior economist at ITG Investment Research. And we have Jared Kizer. He is a director of investment strategy at Buckingham Asset Management. They got responsible for $15 billion. He joins us from St. Louis. Gentlemen, good to have you with us. Michael, I want to start off with you. Take a look at the numbers that were released today in terms of spending, consumer spending. At first blush, looks great, looks fabulous. There's money to spend. But then you start to factor in inflation, and it seems as though the good news is a little bit tempered.
Well, I think you should focus on the good news first.
Okay.
I mean, this is a July figure. This is the first month of the next quarter, of the third quarter. We have better than expected personal income and spending, with upward revisions, by the way, to June.
Right.
We have better than expected industrial production for July, and we have better than expected durable goods for July. What we're seeing is not that surprising, and that is, although the second quarter was negative, what was taken away in the second quarter is going to be given back in the third quarter and the fourth quarter. So we may have gotten overly pessimistic about the second half of the year. Inflation is a different story. I think that certainly Bernanke and the Fed would like to think that inflation is not a concern. It's transitory. The data seems to say otherwise. I'm particularly concerned about the core, and I think the core CPI may be the devil in the detail, with owner equivalency rents beginning to rise at a sustained pace because new home buyers no longer have access to mortgage financing, so they're renting. Rents are going to continue to rise.
Can't buy a house, so you've got to rent somewhere. Jared Kizer, come in on this idea of a little bit too much pessimism in the market, as Michael Woolfolk was describing. In your mind, a green light to go out and buy some stocks?
Well, I think generally what you want to have is a well-thought-out plan that accounts for the types of risks that we're seeing out there right now. If you ask my opinion on this, what we've seen, and a lot of this is coming more so from the back end of the 07-08 financial crisis, and a lot of these things honestly aren't that surprising. You'll generally see that growth is pretty slow coming out of a banking and financial crisis of the magnitude that we saw. Unemployment remains pretty high, and you can see some volatility out there. So in general, I think if you look at the PE, of course, it's fairly low right now, but I think that reflects some of the risks that you see out there, and a better approach is just to stick with a well-thought-out plan where you can stay the course through both the good times and the bad.
Stephen Blitz, risks in the marketplace. We listened to Christine Lagarde speaking at Jackson Hole, Wyoming, talking about bank capital requirements in Europe. You've got a sluggish economy here in the United States. Do you think that everybody knows all of the risks? Is it already priced into the market, or we have more to worry about?
I think we have more to worry about. I don't think everything is priced in. I think, the stock market, look, investors in stocks are optimists by nature. Otherwise, why would you buy? They got a
natural long bias.
There's natural long bias. And so any sense of good news, any modicum of good news, the market's up, because even if the data of late for August is not so good, it means that people think the Fed, fiscal policy, something that's going to come in and buoy the market, so you need to buy.
Yeah, it's bizarre, right? I mean, bad news ends up being good news, because the worse the news is in the economy, the more they think that the Federal Reserve or the government's going to do something to stimulate.
Exactly. Exactly, which is to my way of thinking is a bit bizarre, but like I said, it's optimists make the equity market, the natural long bias. Ms. Lagarde was 100% correct. The problem is, I don't agree with her answers, to the problem, but the problem is there's still a tremendous amount of debt against assets that have depreciated a lot.
You were talking about the banks in Europe.
Well, the banks in Europe, but you can say that here too. You have people saddled with mortgages, even if they're still in their homes making mortgage payments. They have negative equity situations. So people don't have the money to spend, at least certainly not the broad sector of the population. And you're seeing that. And we talked about July data. The July data is a bounce back from May and June. And it's clear from everything that the economy continued to expand in July. And for people doing GDP accounting, it does give the third quarter a big boost. But there's two things to factor in. One is equity market volatility clearly damaged the economy in August. The high-frequency data that we showed that the economy still expanded in August, but it weakened a lot. And secondly, even if the economy maintains the same 1.5% real growth, Bernanke told us in Jackson Hole that 9% unemployment, with half the unemployed population unemployed for more than 6 months, is bad, not only short-term but long-term for the economy, and that should not stand, and that should be the province to fix first for fiscal policy. And if the data continues to weaken, as he thinks it will, to pull inflation risk down below 2%, he's going to ask the FOMC to do something in terms of easing more. And if that's not enough, the data, he's got them locked in there for 2 days instead of 1.
I was going to say, he just doubled the amount of time for the meetings, right? I mean, from September 20th, it's now a 20th and 21st meeting.
So I think he figures if he can get him in there for 2 days, maybe then he can convince him.
You mean strong-arm them a little bit? I guess that's a diplomatic way of talking. Michael Woolfolk?
I don't know if Obama's going to be telling the Fed to do anything, given its political independence. However, it will be telling Congress to get its act together. He's going to bring Alan Krueger on board, and I expect some very exciting things at Alan Krueger, including some new employment stimulus plans.
All right. Michael Woolfolk, we were just talking during the break about what's going to happen after Labor Day, right? People come back to the office. They start to really focus on the remainder of the year for their portfolio. You think we're going to be playing any catch-up? Because, you know, in credit markets, not been too good to investors so far.
Well, look, after the type of summer that we had with 400 points up, down on a day-to-day basis, amidst already a great deal of consternation about debt conditions in the United States, debt conditions in Europe, the Greek angle, of course, those type of high-risk, high-return type of investors have been pushed to the margin. They're long cash, and they've been long, the Swiss franc, the Japanese
yen. They're long
yen.
fear.
They're long fear.
They're scared,
exactly.
right?
Exactly. So it's about capital preservation. So I think that once we get past Labor Day, the markets return to full liquidity. I think what you're going to see is bond investors continue to buy bonds. There's a good reason for that. But also, I think that those that are searching for yield are going to go right back into the equity market, go right back into the commodity market, because they have to. They've been beaten up this year. They need to try to beat their benchmarks by the holidays.
Good point. Jared Kizer, come in on this topic of where people are going to be putting their money. You think stocks, you think commodity-based stocks are going to be attractive?
Yeah, I think in general, what we're seeing is that people are following their allocation plans for the most part. What I would say to all this type of speculation is these types of risks, while we have been in extraordinary times, again, I keep going back to this theme that these types of events are going to happen from time to time. And I think if you're going to earn the risk premiums in the credit market, the equity markets, or any of these riskier based markets, it's just very, very difficult to try to time these things. So I know, at Buckingham, we'll certainly be advising our clients to maintain their plans as long as they're comfortable with the types of risks that they're taking, which have to account for these types of extreme market movements. And a lot of times, this is when people are going to have their tolerance for risk be tested in environments like we've gone through right now, and environments like 07, 08. People figure out just how much risk they can take. But hopefully, they go through that process well before they actually experience to know what type of risk they're comfortable with.
Stephen Blitz, he keeps mentioning this word risk, and I got to wonder. I mean, you were talking during the break. If someone's got, let's say, $10 million, maybe they sold their business. Maybe they got a windfall somehow. They're not going to go and put all of that money in the stock market now, right? Because not only does it make sense, and most people are not necessarily rational, but it makes sense because you may be earning this 3% yield, yet you come back and you say, uh-oh, take a look at what happened August 8th in the stock market. We can't live through that. So what do? You become an embedded bond investor.
Well, unless you're a 23-year-old internet millionaire,
Okay, well, they're a class all by themselves, and they should talk directly to you.
Well, maybe not to me, but not anymore, at least. I don't manage any money. But, when I did manage money, I think the first thing to do for someone to do is to sit down and ask, what is the liability they're funding? What is the timeline of that liability? And what is the true risk along that timeline? And if you sit down and answer that question, and that's not a finance question, it's a very qualitative type of a thing.
That's like things like school and education,
retirement,
and housing,
exactly,
healthcare.
Exactly. Answer those questions honestly first, and then from there, your investment profile just falls right out of it naturally.
But you told me about one of your mentors in the business. What did he teach you about bonds?
Well, that nobody invests in bonds to get rich twice.
Right? You do it to save the wealth.
Exactly, to preserve the assets against inflation and to leave something for heirs and/or to give the money to, whomever you want to give the money to.
Michael Woolfolk, I mean, if that's part of the investment strategy right now, and I got to think that there are banks in Europe who are, asking themselves these serious questions, do you think that there is any outflow, let's say, from sovereign, any more outflow in terms of sovereign debt in Europe?
Well, I think that sovereign debt in Europe is a big question mark right now. However, you do need to have a blended portfolio, and on the debt side, there are so many, AAA, AA type of credits. You have to have some exposure, corporates to Europe. So I'd say yes in terms of continuing to invest in Europe. On the debt side, I think that one of the things you can't afford to be is overly long cash right now. That I think is going to be increasingly expensive. I think the opportunity cost is going to be expensive. We're already starting to see, including some announcements by some of the major Swiss banks today, that you're going to be punished by holding cash on the sidelines increasingly.
So maybe Ben Bernanke is going to get his wish. He's going to push everyone into riskier assets.
Well, hopefully more productive assets.
Well done. Well said. I want to thank you, gentlemen, very much. Michael Woolfolk joining us from Bank of New York Mellon. Also, Stephen Blitz from ITG Investment Research. And Jared Kizer joining us from Buckingham Research.